Relative valuation is more commonly used than intrinsic valuation, that is DCF. Here's why. First, it is easier to defend. In DCF, assumptions are exposed and can be challenged. But in relative valuation, these assumptions are embedded in the multiples, making them harder to dispute. It's easier to sell. Saying this company trades at 10 times earnings while peers trade at 15 times is more convincing than explaining DCF assumptions. And the third is that it's safer to be wrong in a crowd. With DCF, you're often wrong alone. In relative valuation, you're wrong with the others, making it safer in the corporate world. The 4 steps of relative valuation are: step 1, that is defining the multiple. A multiple compares a value metric to a performance metric. Value metrics: price equity value for PE, PB, and EV, that is the enterprise value for EV EBITDA, EV by revenue. So performance metrics: earnings, EPS, EBIT, and revenues or book value. These ensure consistency. If using equity value, that is the price, pair it with equity performance metrics, that is the EPS. If using EV, pair with firm level metrics like EBITDA or revenue. Step 2, describing the multiple. Plot the multiple across your industry. Check the median, range, and skewness. Multiples are typically right skewed. This helps you understand whether a multiple like PE 20 is high or low for your sector. Step 3 is analyze the multiples. Each multiple has implicit assumptions. Like a high PE might suggest high growth expectations or low risk. EV by EBITDA might favor companies with lower capital expenditures. Understanding these assumptions helps you judge whether the market is too optimistic or pessimistic about your company. Step 4. Apply the multiple. Pick comparable companies based on industry size and risk. Use the sector median or mean multiple or adjust with regression. Apply the multiple to your company's fundamentals. If your company has better margins, lower risk, or better growth, you might justify a premium multiple. Example, applying EV by EBITDA. If your company's EBITDA is rupees 500 million and average EV by EBITDA for peers is 10 times, then implied EV would be 500 multiplied by 10, that is 5,000 million rupees. Subtract net debt to get the equity value, then divide by shares to get the implied share price. If the stock trades below, that means it's undervalued. The key takeaways would be: relative valuation is about pricing, not valuing. Use it wisely, not blindly. Always define, describe, analyze, apply. Even if you prefer intrinsic valuation, understanding relative valuation is essential since the world runs on multiples. Thank you. That's all.